What's up everybody, welcome back to The Contrarian. I'm Logan. Today I'm just going to be doing a short video about why I am actually getting ready to buy my first Treasury bonds. And I almost never thought I would be getting into Treasury bonds to begin with. But in this video I'll kind of lay out the groundwork for why I do think bonds are going to set up for a really nice rally in the coming year in 2023. So let's just get started right away. So bonds, to begin with, have had a very, very bad year. Year to date, they're down anywhere from 30 to 45+%, just looking at the total bond indices. And this is really, really poor. You have to go probably into crypto and growth stocks to get this kind of really awful performance in the last year. Even the stock market has not done as bad as bonds have fared, and this is really rare to see. It's very rare to see the stock market go down and the bond market actually underperform the stock market. In fact, typically during stock bear markets, the bond market will actually rally as it anticipates the Fed beginning to cut rates, and therefore bond prices begin to go up as that anticipation builds. There's basically a teeter-totter type relationship between bond yields and bond prices. So as the price of a bond goes up, the yield will drop and vice versa. So you need to keep in mind that it's basically going to fluctuate in that way. And in the last year, we've had bond yields, especially on the short end of the credit spread, go through the roof from very close to 0% to where now the 2-year is yielding almost 5%, about 4.8%, which is the most it has yielded in about 15 years, which is crazy to think that in under a year you can go from basically a 0% yield to practically a 5% yield on the 2-year. Now, why could bonds benefit greatly in the coming year? There's a few factors that go into it. Obviously, the Fed pivoting would be needed for this to occur, and you really don't have to look very far in the economy to see disinflation building, disinflationary pressures building. Natural gas has come down very dramatically. Oil has come down dramatically from its highs as well. So a lot of the impetus for inflation being a very big word in 2022 is beginning to reverse course, and the theme of 2023 very well could be a big disinflationary cycle, and that would prove very bullish for bonds, because as you have inflation coming down, but as you have bond yields being very high, as they relatively are right now for the last decade, institutional investors are going to go very heavily into bonds, as there's decent return to be made there, as cash is continuing to be eaten away just by the inflation that still does exist, and as the stock market maybe doesn't catch up as much as it has in the past, people could begin to start looking elsewhere other than stocks and crypto and things like that where they've been in the past, and start looking into bonds, which have become a much more attractive investment. And for myself, I'll actually be allocating some of the cash that I have sitting around right now into bonds. So it's not going to be like I'm selling some stocks and going into bonds. It's more so just more allocating cash type of capital. And institutional investors, other investors could be doing the same things of saying, hey, it really doesn't benefit me right now to have as much cash sitting around as I currently have. I'm just going to put some of that into Treasury bonds, which are yielding a lot more than they typically have in the last decade. So you have the backdrop of bond yields being high, of disinflation occurring, people seeing bonds as more attractive, and that does set up for a very decent rally in the bond market, because as you have yields coming down, even just let's say the 10-year drops down to 3%, maybe 2.5% at some point in 2023, you would see the price of the 10-year go up fairly dramatically from where it is right now. And so in that kind of scenario, you could be looking at some pretty decent returns occurring in not too long of time frames on bonds. Even if you don't want to hold the bonds to maturity, it's very possible that you could make a pretty sizable return in just the coming year or so if yields do come down as much as I personally kind of anticipate them doing so. Obviously, I'm not trying to provide advice. I'm simply talking about my analysis, what I currently see as occurring. And remarkably, this could be a pretty decent time myself. I'm going to be acting on this pretty soon. Because first, like the last month in 2023, month of February, we did see yields jump again as investors begin to anticipate more Fed hikes ahead. I'm just personally skeptical as to how much more the Fed can really do. I don't think they can go much farther without breaking something structurally in the monetary system and then having to backpedal very quickly. Obviously, we'll really have to see the time frame in terms of how long it takes this leading data that I'm more so looking at. Maybe the housing market, natural gas, oil would be major things I'm looking at that are indicating a lot of disinflation ahead. But it's going to take some time for that to trickle down and actually, make its way into CPI, PPI, and things like that. So in terms of how long it actually takes the Fed to act on that is a whole separate question entirely. I don't really know. I would have thought they actually would have begun to see these things already, but that, like usual, they are way behind the curve in terms of the tightening cycle as well that they've been on. So all of this being said, I do not want this to be taken as advice saying that you should buy Treasury bonds. I'm simply saying that in my mind, with my analysis, bonds could be setting up for a really sizable rally this year as the dollar begins to sell off, as yields begin to come down, as well basically as extreme trends that we saw in 2022 begin to revert back to where they would historically be. Bonds could have a very sizable rally in that kind of a situation. But all that being said, let me know what you think down in the comment section below about the bond market. Is it as attractive as I personally see it right now? But yeah, let me know what you all think down in the comment section below, and I hope to see all of you again at some point.